Welcome to Accounting 101, Lesson 7, Division of the Ledger. So, first of all, a definition of what a ledger is. It's a book in which the monetary transactions of a business are posted in the form of debits and credits. Or another definition here, it's a book to which the record of accounts is transferred as final entry from original posting. So those have both been lifted straight from a dictionary. But for us, I think we just need to think of a ledger as a book or a folder containing a collection of individual T accounts. Probably much easier to visualize when we're thinking about a manual bookkeeping system rather than one on a computer. Okay, so before we can get going with division of the ledger, we just need to have a little recap on source documents. So we need to know what a sales invoice is. So a sales invoice is a document that is raised and sent to a customer when they buy goods on credit from us. Purchase invoices, those are ones that are received from suppliers when we buy goods on credit. We've got sales credit notes, so that's what we issue to a customer when they return goods to us, perhaps because they're faulty or they're no longer required. And a purchase credit note is a credit note that we receive from our suppliers when we return goods to them. Other source documents that aren't going to be used in this particular session, but things that we need to be aware of. Check counterfoil, so checkbook counterfoil or a stub is the source document when a check is paid out. We've got paying in slip counterfoils, which is when we pay money into the bank account, and we'll learn more about those when we look at the cash book in a later session. The bank statement is the source document for direct debits, standing orders, bank transfers, bank charges, anything that's paid or received directly to or from our bank account. And then cash receipts for cash sales and expenses and purchases that are paid for in cash. Okay, so the sales documents that we're interested in today are these first four to do with credit customers and credit suppliers. So those documents need to be entered into something called books of prime entry. So a book of prime entry is a book where we collect or summarize all of the transactions that have gone on, usually for a period of a month at a time. They're totaled off and then posted into the individual ledgers, which is what we'll be looking at in just a second. So sales invoices are entered into something called the sales journal, and the sales journal, as we'll see in a minute, is just literally a list of invoices that have been raised for a particular period. It might be a month, it might be a week, it might be a quarter. Purchase invoices, those are entered into something called the purchases journal. We've got sales credit notes that are going to be entered into the sales returns journal. Purchase credit notes are entered into the purchase returns journal. Bank and cash transactions will be entered into the cash book. And any non-routine transactions, things like correcting errors, contra entries, which we'll learn about later on, those are going to be entered into something called the general journal. So you've got 6 books of prime entry that you need to learn about. We're concentrating on the first 4 in today's session. Okay. So the sales ledger, if you remember, the ledger was just a folder that contains the accounts of individual credit customers. Now, the sales ledger is only interested in credit sales. We're not in the least bit interested in any cash sales. They're posted directly into what we call the nominal ledger, into the sales account and into either the bank or cash, depending on how the customer paid us. So the sales ledger is only concerned with credit customers. And the reason we need to keep a separate record of these is these are people who owe the business money. So at the end of the month, we're going to be sending them out a statement which will show how much the customer has bought from us, so what sales invoices we've sent to them, anything that they've sent back and any credit notes that we've issued, any discounts that we've given to them, and any amounts that we've received from them. So all that information is contained in each individual customer's account within the sales ledger. So as I said, the individual customer accounts are going to contain details of sales made on credit, sales returns, any receipts from the customers, and any cash discount that we've allowed them for prompt settlement of their account. The other thing we might have to enter into a sales ledger account is something called an irrecoverable debt. So if the customer doesn't pay us and we've failed to collect the money, perhaps because they've gone into receivership, they've gone bankrupt, then we sometimes need to write the debt off. And that will be dealt with in a separate session on the general journal. Okay, so the key thing is that the sales ledger does not record cash sales. So as I said, we've got this sales journal. It's a list of the sales invoices issued to credit customers, totaled at the end of each month usually, although for a very big business it might be done weekly. For a very small business it might be done monthly. The total sales figure from the sales journal is going to be credited straight into the sales revenue account in something called the general ledger. Now we're splitting our ledgers. We've got, rather than just one big pile of T accounts, we're going to be splitting them into three areas. So one is going to be the sales ledger, one is going to be the purchase ledger, and then everything else is going to be going into the general ledger. So the sales ledger will contain the accounts, if you remember, of all the individual customers. Purchase ledger will contain the accounts of all the individual suppliers, and the general ledger contains absolutely everything else. So when we look at the sales journal, we're going to be debiting the individual customers with the amount of each sales invoice, and I'll show you how that's done in just a second. So this is an example of the sales journal. So you can see here we've got the date of the invoices. This is for the month of January. Details, these are the customers' names that goods have been sold to. These are the invoice numbers, so they're sequential as you'd expect. The reference number refers to their account number within the sales ledger. So that would be more usual if you're using a computerized system rather than a manual one. And then the amount of each sales invoice is going in there. Now, the AQA syllabus actually ignores VAT or sales tax, as you might know in the US. So we haven't got any columns here, extra columns for things like VAT or sales tax. So I'm now going to show you how the transactions are posted from the sales journal into the individual T accounts. Okay, so we're now going to post some transactions from the sales journal into the T accounts, and we're going to use division of the ledger. Now, what I've done is already set up some T accounts. So I've, in this example, just set up a page entitled Sales Ledger. So in real life, this would be a folder. It would have all the customer accounts in it, trade customers, ones that are on credit, not cash customers. We don't need to keep any records to do with those. So I've set up, there are three customers that we've sent invoices to. So I've set up three sales ledger accounts. I've also set up in the nominal ledger, I've got accounts for sales, for purchases, for sales returns and purchase returns, because we'll be posting from the other journals, so from the purchases journal and so on. So I'm just going to show you now how this will work. So we've got a list of invoices here and a total here. Now basically what's going to happen is that these amounts here, the individual invoices, are going to be debited to each customer's account. Okay, so debit the customer's account, and that's going to be in the sales ledger. This total is going to be credited to the sales account. Okay, so that's going to be in the nominal ledger. So that's basically how it's going to work. So 3rd of January, we've got an invoice number 901 to E. Doyle. This reference here would just be a sales ledger account number. I haven't bothered putting those in there, but if you wanted to, you could put the reference number in there. So he's SL58, for example, but we don't need to worry about that. So it's just straightforward posting into the T account. So we're going to do E. Doyle, 3rd of January, and it's sales. So £80 goes in there. We'll do the same for A. Sparks. So on the 8th of January, again, sales, £200 there. 12th of January, T. Young. 12th of January, sales there. T. Young was £80. And then on the 18th of January, back to A. Sparks. Another invoice raised there. Sales, £120. Okay, the reference here, you could put sales journal, SJ, in there, or just sales, doesn't really matter. What we're doing though is, rather than post all of these individual amounts into the sales account, on the 31st of January, we can see that the total for the month is 480. So 31st of January, and we've got from the sales journal, we've got £480. So we can just stick that in one lump. We don't need to write all these individual entries. So it does save a little bit of time with the bookkeeping. So just to summarise then, when we get accounting for credit sales, goods are sold on credit to the customer. We raise sales invoices that's sent out to those customers. Those invoices are then entered into the sales journal, which is a book of prime entry. Then the double entry bookkeeping takes place at the end of the month. When we total up the sales journal, we debit all of the accounts in the sales ledger, and we credit the general ledger with the total amount of sales. So we can see there the individual accounts are debited and the credit is going to the sales revenue account. Okay, so the purchases ledger, much like the sales ledger, except this time we're dealing with individual credit suppliers. So it's just a folder that contains the T accounts of all the individual credit suppliers. So these are people that the business has bought goods from, goods for resale, that's purchases, on a credit basis. So we haven't paid for them at the time the purchase took place. So the transactions that are going in there, purchases made on credit, purchase returns made by the business, any payments that we've made to the trade payables, either by bank or cash, any cash discount that we've received from our suppliers for paying them promptly. And the one thing that the purchase ledger does not record, as I mentioned with the sales ledger, it doesn't record any cash purchases. So remember when we use the term cash, it just means that it's paid for at the time. So cash sales means the customer has paid for the goods at the time. They've not been allowed any credit. Same with cash purchases. We've paid for the goods. We haven't been allowed credit by our suppliers. One other entry that you might see going into these sales and purchase ledger accounts is something called a contra entry, which is where we've got someone who is a customer and a supplier. So I'll deal with the contra entries. I think I might have already mentioned when I do a session on the general journal. So watch out for that one. Okay, so the purchases journal is a list of purchase invoices received from credit suppliers. Again, it's totaled at the end of each month, but that could be weekly, could be monthly, could be quarterly. And then the total purchases figure is going to be debited to the purchases account in the general ledger, and each individual invoice is going to be credited to each individual supplier account within the purchase ledger. So this is an example of a purchases journal, so it looks very much the same as the sales journal. We've got the date going down there, details of the supplier, in this case only two different ones, P Bond and D Webster. The invoice numbers, which in this case are not going to be sequential. Remember that this is purchases, so these are invoices coming from suppliers. And again, we've got a reference here which would refer to their account number within the purchase ledger. And then the bit that we're interested in here, the amount. So if you remember, we're going to be debiting purchases with this entire 360 and crediting the individual supplier accounts. I'm going to show you how that's done now. So we're now going to look at posting the purchases journal. So here's a purchase ledger that I set up earlier, and as you can see, all it is a sheet of T account paper just been headed up purchase ledger. In real life, this would be a folder that would contain all the accounts for the suppliers. One of the ideas behind dividing the ledger is that you can assign people different roles. So in a very big organisation, it might be one person or a team of people, in fact, that are dealing with each of these ledgers. So one person might manage the sales ledger, they might do all the credit control, and someone else might manage the purchase ledger, making sure that suppliers are paid on time and that any discounts that they're due are taken, that kind of thing. Right, so back to this purchases journal then. We've got 3 purchase invoices for goods that we've bought during the month of January. So we're just going to enter each of these into the supplier's account. So the individual entries are going to be credited to the supplier's accounts. And then the total is going to be debited to purchases. So the supplier accounts would be in the purchase ledger, and the purchases account is going to be in the nominal ledger. So if we just have work out the best way to do this. 2nd of January, so crediting the supplier's account with purchases. So this is following our dear clip. We're debiting purchases, always debit purchases, and then credit the supplier account. Or if the purchases have been paid for, credit the cash or the bank, however they were paid. So it's following our double entry. So purchases £80, D Webster on the 11th of January. Purchases. Apologies for my creaky desk, by the way. I hadn't realised it was quite so noisy. And then the 16th of January, we're back to P Bond. Invoice number 1247. Purchases £160. So we've put those 3 invoices into the relevant T accounts within the purchase ledger. And now we can go back over to the nominal ledger and we can debit purchases with the full amount. So 31st of January, and we're going to make the reference there, purchases journal. This is so that we can find out where that total has come from, 360. So you can see there we've got 3 credit entries to the supplier accounts. There they are, 1, 2, 3, and then just 1 entry into the nominal ledger. So just to recap then, accounting for credit purchases, we buy goods on credit, we make purchases, we receive purchase invoices from our suppliers. Those get entered into the purchases journal, which is a book of prime entry, one of the 6 books of prime entry. The double entry bookkeeping involves the general ledger and the purchases ledger. We're going to be debiting the purchases account with the total amount of purchases, and that's going to be found within the general ledger. And we're going to be crediting each individual supplier's account with just notice an extra apostrophe in there, apologies for the typo, but we're going to be crediting the individual supplier's accounts, which will be found within the purchase ledger. Okay, so sales returns journal. I'm sure you can guess what happens here. This is going to be a list of all the credit notes that we've issued to customers, and it's going to be totaled at the end of each month. And at the end of the month, we're going to debit the total figure for sales returns into the sales returns account, which is going to be in the general or nominal ledger. And then each credit note is going to be credited to the individual customer account within the sales ledger. So we've got here a sales returns journal, which gives us details of the date that the credit note was issued, who the credit note was issued to, which customer, a credit note number, which is going to be sequential, and then the reference number for each of these customers within the sales ledger. And then the important bit for us is the amount. So this is going to be the opposite way around to how we did it for the sales invoices. So this time we're going to be debiting the sales returns account with 160 and crediting the individual customers. And I'll show you how that's done. Okay. So this is your sales returns journal. This is credit notes that have been issued to customers. And we are going to post those into the sales ledger, and the total amount for sales returns is going to go off to the nominal ledger. So we're going to debit sales returns. If you remember, it's the opposite of sales. That's going to be an account within the nominal ledger. And then we're going to credit the customer's account within the sales ledger with each of those amounts. So T Young, we issued a credit note on the 15th of January. So 15th of January, sales returns. So we're reducing the amount that T Young owes us. We'd invoiced him for £80. We've sent him a credit note for £40. So we need to credit his account with £40. And then A Sparks, we've issued a credit note on the 25th of January. Sales returns, £120. And then in the nominal ledger, I've got an account here for sales returns. It's the opposite of sales. Sales is always a credit. Sales returns is always going to be a debit. It's the opposite of sales. So on the 31st of January, we've got from the sales returns journal. I struggle to fit all that in there. Just abbreviated the word returns to RET with a dot after it. So we've got £160 in there. And that's it done. That's it for the sales returns journal. Just to recap, accounting for sales returns, when goods are returned by the customer, we issue them with a credit note. That gets entered into the sales returns journal. We then complete the double entry, which is found in accounts within the general ledger. So the sales returns account is within the general ledger, and then the individual customer accounts are within the sales ledger. So debit the sales returns account with the total for the month and credit each individual customer's account. Okay, so purchase returns journal. I'm sure you can guess how this one works. It's a list of the credit notes that we've received from credit suppliers. Again, it's going to be totaled at the end of each month, and the total purchase returns figure gets credited to the purchase returns account in the general ledger. It's the opposite of purchases. Purchases is always a debit. Purchase returns, when we send goods back, is always going to be a credit to reduce that purchases figure. And then each individual credit note is going to be debited to each individual supplier account within the purchase ledger. So we've got an example here of a purchase returns journal. Again, we've got the date, we've got the supplier name, we've got it should say credit note rather than invoice up there, apologies for that, and then a reference number within the purchase ledger. So this total of £80 is going to be credited to the purchase returns account within the nominal ledger, the general ledger, and we're going to debit P Bond with £40 and debit D Webster with £40. So I'll show you how that's done now. These are credit notes that have been received from suppliers. Okay, so we've received a credit note on the 6th of January from P Bond, £40. So we're going to debit the supplier's account within the purchase ledger, and we're going to be crediting purchase returns within the nominal ledger. Okay, so purchase returns is the opposite of purchases, so it's going to be on the credit side. So this one here, 6th of January, P bond £40. So 6th of January, purchase returns £40. And then on the 20th of January, D Webster, also £40. Pop that in there, purchase returns £40. And then we go back to the nominal ledger, and in purchase returns, 31st of January, we've got the purchases journal, £80. Okay, so that's all there is to it. Pretty straightforward. So it's a strange topic, division of the ledger, but actually it's pretty straightforward when you get down to it. Just to recap then, purchase returns, goods are returned to the supplier. The supplier is going to issue us with a credit note, which we'll then enter into our purchase returns journal, book of prime entry. Then we complete the double entry bookkeeping by debiting the individual supplier's accounts with each individual credit note that we've received and crediting the purchase returns account. Okay, so the bookkeeping's all complete now. You've seen how it's done. So just to summarise, it is a very straightforward concept. It just means that the T accounts are grouped together. We've got the sales ledger containing all the trade receivables accounts. We've got the purchase ledger containing all the trade payables accounts. And the nominal ledger has got literally everything else. So that would be things like assets. It would be expenses. It would be just anything except for customers and suppliers. And by dividing the ledger, we can enable different people to take control of different tasks. So if you imagine a folder with all the customer accounts in it, somebody can be responsible for maintaining those, for issuing invoices and credit notes to customers, dealing with queries, processing any money that's received from the customers, and where necessary, dealing with credit control, so sending out the statements at the end of the month and then chasing the customers up for payment. And the same could be done with suppliers. So in a very large organisation, there might be a team of people dealing with the purchase ledger, so dealing with the suppliers, negotiating discounts, making sure that the invoices are all processed, that the invoices match up to the purchase orders, all those kind of things. Anyway, I hope you've enjoyed watching, and I'll see you again soon.